A lot of factors say silver's broken out. It's got the monetary excuse, it has the fundamental excuse, and the technical scream at you that it's headed to a new reality. No, I expect silver when you get up to 300 to 500, believe me, I'm going to be looking to take profits. But what I'm not going to do is put the money into cash, paper cash. I'm putting it into gold bullion, real money, unleveraged, and leave it alone. That's my idea of cash.
We're still like around 36% of the level from 1980, which means there's still a lot of room for volatility, which would mean for volatility to go up, which would mean much higher prices. And even if you look back here at the highs in 2020, we were near 30. Historical volatility got up to over 100. Yeah, this time around we are at the highs here, and it's only around just above 80. And in 2011 as well, when silver traded up to almost 50 again, it was at 133. If you look at historical volatility, it's nowhere near like 1980, nor even 2011. And that's why I think the bull market in precious metals and the bear market in fiat currencies and government bonds is still got some years to go.
Silver is breaking out with strong momentum, backed by technical signals and macro fundamentals. The move is gaining traction as volatility remains far below historical extremes. This suggests the current rally could be far from its peak. MarioInnecco, a macro-focused analyst with years of experience in tracking global market cycles, and MichaelOliver, widely recognized for pioneering momentum analysis in commodities, explain that silver's structure points toward a much larger upside move. Historical volatility, currently near $80, remains significantly below levels seen during prior major peaks, over $130 in 2011 and above $200 in 1980. This gap implies that the market has not yet entered its final explosive phase. From a technical standpoint, momentum structures continue to signal a shift into a new price regime, while fundamentals such as monetary debasement and growing demand reinforce the bullish outlook. Price projections in this cycle suggest that silver could move into the $300 to $500 range over time, with volatility expansion acting as the catalyst. The strategy emphasized is not to rotate back into fiat, but to preserve gains in hard assets like gold, reinforcing a long-term wealth protection approach. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
We argue from a major technical point of view, but we also know there's fundamentals in play. Everybody does. I mean, for 4 or 5 years now, you've had a deficit production to demand. Okay, new silver to meet demand. It's not meeting it. And demand is exploding. One of the factors is China solar production. They constitute like 80, 90% of global solar production. And it's a hot demand subject. And silver is a component within that. Okay, a minor component, but still consistent, but needed component of voltaic cells that make up the solar panels. Okay, now, at higher energy prices like oil is helping turn the public attention in the world to, hey, let's find an alternative. India, for example, is going very deep into getting into solar production for general power purposes. Okay, forget that. Silver is a monetary metal. You go back 3,000 years, it's money, okay? You can't forget that. It's always been. In fact, some governments have made it money. We've made it money, okay, at one time or another. So it is the baby gold. It's the poor man's gold, as they say. If you look at gold, go back 50 years when it was legalized here in the U.S. in 75, there have been multiple major bull markets. For example, after it was legalized, it was $200, and it went down to 103 by summer of 1976. And it went from 103. By 1980, it had eightfold gain in price. It was over 800. Eightfold gain. Okay. Think of dimension, not dollars here. Okay. Then it pulled back, and in 2001 and 2, it made lows around $265 an ounce for a couple years. After having been 850, it pulled back to 260 something and based. And from that 260 level, eightfold gain by 2011. Different time span, but same gain, eightfold, $1,920 peak. Okay, so twice in 50 years, it's produced an eightfold bull market. under conditions that aren't nearly as fundamentally dramatic as what we've got building under our feet. Okay, gold right now is only fourfold. Our bear low, last bear low, was in 2015 at 1,050. Okay, we're trading either side a fourfold gain. Okay, if gold merely does what it did before, like, oh boy, I'm going to do it again, sort of boring almost. I'm going to go to $8,500 gold. Okay, that just replicates the two prior bull markets. Okay, now we've argued that that's not a target. That's just pointing out a fact. Don't look at the dollar value of gold. Look at the multiple gains it's produced on a percentage basis. Now, during that same 50-year period, silver stuck at the highs 50, 50, 50. Gold made new highs in each bull. Silver would go up with gold, but it couldn't get through $50. What was going on there? How come silver can't do it? Go back and look at a copper chart, base metal. Between 1970, 80, 90, 2005, copper was in a multi-decade range from 50 cents a pound to $1.50. So let's call it $1 average. For multiple decades, it decided in late 2005, no, I'm not going to stay in the old range. It quadrupled in price and got up to like $4.50 within several quarters of having broken out through that multi-decade price range. And it did it on its own. It didn't have to have a massive commodity surge with it. Gold wasn't doing with it. The same thing copper did. And in lead, did the same thing in 2007. After multiple decades of boring horizontal range, it like quadrupled in price in a matter of several quarters and lived in a new reality after that. Yeah, they were sharp drops, but never did copper go back to $1. Okay. It stayed in this range of $4.50 to $3 for a couple decades. Of course, now we pushed up towards $6. How come silver was stuck in a 50-year box? Copper wasn't, lead wasn't, gold wasn't, but silver was. Well, there are arguments about it being artificially restrained. Well, when a market makes a mistake, whether it's a bubble stock market top, goes too far, too long, when it compensates for the mistake, it often overcompensates. In other words, it has a tantrum in the new direction. It unleashes. In this case, is silver. It's compressed for half a century in an unreality that's not comparable to any other metal. And so it says, hey, I'm out of here. Well, if you take the dimension of silver's range of the last 50 years, $4 lows 50, $4.50, $4. Call it a tenfold range. What's tenfold above 50? Okay. Now, if you take simply money supply, M2 chart, and go back to 1980 and ask yourself, how much has M2 grown since then, when silver was 50 then? Whoa! Or 2011 when silver was 50 again. How much is the money supply? If you factor that in, you're talking several $100 silver just to compensate for the decay in the money unit. Now, the other thing we've learned is when silver has a tantrum like this, and the run-ups to $50 were tantrums within the range, however, and copper, or the lead chart that I mentioned, where they did it in a couple quarters, we find that this immersion into a new reality quite often doesn't take years. It takes a couple of quarters. It seems to be routine almost, in fact, that when you have a tantrum like this, you get it done quickly and very efficiently, overcompensating probably. Well, we can come up with all kinds of reasons, both technical and the monetary fundamental, for example, that says, hey, $300 to $500 is only fair priced. Okay. And the history of these kind of emergences of markets from old realities to new realities is speed. And couple that with the fact that we're in an ongoing monetary bull market anyway. So it's not like silver's having to fight a negative trend with gold. Gold's in a positive trend. Silver is just saying, hey, I'm going to catch up to you. In fact, I'm going to beat you in terms of percent gain. And it started that as well when you measure silver versus gold on a technical basis, which we do month to month. We had a breakout last November in the spread favoring silver over gold. Well, what was the price of silver last November? $56. Dec, Jan, Feb. Of course, by January, it was 120. Okay. And now we've got an average price of the last 3 months of 75 to 80 average of the up and down violence. Right now, we're trading around 74, I think.
Yeah.
So anyway, a lot of factors say silver's broken out. It's got the monetary excuse. It has the fundamental excuse and the technical scream at you that it's headed to a new reality.
Silver is entering a phase that looks very different from anything seen over the past several decades. Long-term supply deficits, rising industrial demand, and a powerful technical structure are aligning. From a structural standpoint, the market has been constrained within a multi-decade range, even as other commodities broke into higher price regimes. That prolonged compression often leads to aggressive expansion once the breakout begins. At the same time, fundamentals are reinforcing the move, with demand from sectors like solar energy continuing to accelerate while new supply struggles to keep pace. Monetary conditions also add to the pressure, as expanding the money supply and currency debasement increase the relative value of hard assets. When similar transitions have occurred in other markets, the move into a new price range has tended to happen rapidly rather than gradually. Combined with an ongoing bull trend in gold, the setup suggests silver may be shifting into a new pricing reality with significantly higher levels ahead. Let's get back to the interview.
Historical volatility is a little different than implied volatility. Historical volatility takes the closing prices over a fixed period of time, and it measures how much prices have moved over time. It's a backward-looking thing, yes, but it's also used in the options market for futures, and there's something called implied volatility. It doesn't give, it's not a predictive, it's not saying, well, we're going to go up here. All it's saying is that, is showing you how volatile the market has been at certain points. And so I got the call from the gnome yesterday, and it's something I haven't looked at really that much, historical volatility. And he said, go on investing.com, and all of you can do this. And he said, go into the futures part, go into silver, go into the monthly chart, and go back to the beginning of the chart, which is around 1973, 74. And then you go under indicators, and you click on that, and you find historical volatility, and it'll show underneath the price. And I was quite amazed by this because I didn't realize that historical volatility right now is around 83. And if you go back to 1980 when silver hit almost $50, historical volatility got to like 231. According to the Gnome of Zurich, means that we could still see a massive move higher, because volatility in the precious metals, unlike in the stock market, goes up when the market goes up. In the stock market, volatility goes up when the market goes down, right? So he thinks there's huge potential. And yes, we've made videos in the past month or so, maybe a little longer, saying that a breakout could be imminent. And it hasn't happened, but I think it's still very possible. And MichaelOliver, as well, from momentum structural analysis, he thinks we could see major breakout in silver by the summer. So yeah, right now we're still like around 36% of the level from 1980, which means there's still a lot of room for volatility, which would mean for volatility to go up, which would mean much higher prices. And even if you look back here at the highs in 2020, we were near 30. Historical volatility got up to over 100. Yeah, this time around we are at the highs here, and it's only around just above 80. And in 2011 as well, when silver traded up to almost 50 again, it was at 133. So yeah, that's why when there are a lot of analysts out there, technical analysts, who are comparing what we've seen, the top at the end of January in gold and silver, they're saying that is like 1980. But if you look at historical volatility, it's nowhere near like 1980, nor even 2011. And that's why I think the bull market in precious metals and the bear market in fiat currencies and government bonds is still got some years to go. And now I'll show you the chart of gold historical volatility. That one as well. Back in 1980, when we got up to almost 900, it went to like 108. And right now we're only at around 43. So still a lot of room on the upside. Anyway, yeah, markets are still all over the place. I guess the geopolitical uncertainty is still there, but I would stick to being like patient and realizing that the fundamentals, by the fundamentals I mean the fact that central banks and governments need to keep inflating because that's the only way the current system functions, right? The fiat currency system. The more debt we get, the more debt we need to roll over. We need to debase the debt. That's the only way the United States, the UK, the West, every country in the world really that has a lot of debt, the only way they'll continue to carry and pay that debt short of defaulting, and I don't think the US will default because they can always print, is printing, right?
Volatility in precious metals is quietly signaling that the current cycle may be far from complete. Silver's historical volatility remains well below prior peak levels, even as prices approach key resistance zones. This divergence suggests that the market has not yet entered the final high-energy phase typically seen at major tops. In past cycles, volatility expanded aggressively as prices accelerated, reaching levels far above those observed today. The current reading implies that price action could still have significant room to run if volatility begins to rise in line with historical patterns. Unlike equities, where volatility often spikes during declines, precious metals tend to see volatility increase alongside price, reinforcing bullish momentum. At the same time, ongoing monetary expansion and rising debt levels continue to support long-term demand for hard assets, creating a strong fundamental backdrop. With both technical and macro conditions aligned, the broader trend points toward further upside potential in gold and silver over time. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.